Okay, today we're going to try to better understand what's driving markets by taking a dive into the concept auction market theory, commonly abbreviated as AMT. Auction market theory uses the idea of breaking markets down into a simple auction to better explain what's driving these more complicated financial markets. Auction market theory, the way I have it defined personally, is markets function like a simple auction, cycling around value. As price reaches the extremes of value, an imbalance of supply and demand is to be expected, which will either cause mean reversion or a trend seeking new value. Value is the price range which buyers and sellers agree upon for a given period of time. The longer this agreement occurs, the more important that value will be. That's pretty much the only real important rule around value. Next, we have the passive and aggressive participants, also known as maker and taker. The passive participant is going to be the maker and the aggressive is the taker. The maker or liquidity provider will place passive orders through bids and offers to buy and sell at specific prices on the order book, whereas the taker will take liquidity from the order book at the closest bid or ask in order to execute instantly. The relationship between these two participants is a core principle to markets, and ultimately this is what's driving price up and down, because when you have that imbalance or makers are overwhelmed by takers, price will move in the direction of the taker until the taker's size is met. Next, we have balance versus imbalance. Balance, or range-bound price action, occurs when there's an agreement between buyers and sellers as to what fair value is. When price becomes expensive or inexpensive, that supply and demand imbalance will take over and cause price to likely mean revert. Imbalance, or trending price action, will occur when price rejects from fair value in order to seek a new one or a pre-existing one. Price will continue moving until that supply and demand imbalance is met again. This shift between the two is cyclical, which is incredibly important to point out because you're always shifting between the two, and that understanding will allow you to A, deploy the appropriate trading style, and B, anticipate the shifts. So now we're going to go on to a couple simple examples. The first one, to lay the groundwork for the later examples, is going to be you're selling a vehicle to a family member, so you own the vehicle, so you are the market maker because you're going to be providing an offer, and your family member is going to be the liquidity taker. They're going to come and take by filling at whatever order, at whatever you quote them at, because you are the market maker in this example. So you say, I'm willing to sell at X price, and they either come and take that fill or don't buy the car from you. From that concept, imagine that when you're dealing with something a little bit more complicated, like an internet marketplace, when you have multiple passive participants and multiple aggressive participants, imagine how that's going to now affect the supply and demand imbalances. The nuances are going to start to get a little more complicated. Okay, and then with our last example, we're going to do the car dealership example. So we are running a car dealership. We have a truck to sell. Our job is to sell as many of them as possible. Through the auction market theory process, we can better understand why the price on these vehicles will move up and down. So the standard price that most of the time this vehicle is going to be sold at is $25K. If 1,000 of these trucks have been sold in the last year, you're going to have, 70% of them roughly are going to have been sold around this $25K price. Occasionally, due to supply and demand imbalance, price will go up or down and get to the points where it's perceived to be expensive or inexpensive. So, as price is cycling around the mean, occasionally there's going to be a change to demand or supply. It can happen with either or, and then the relationship will start to take over. So a simple example would be there might be a reason why demand maybe picks up from consumers on this vehicle. It could have something to do with marketing. It could have something to do with some sort of social dynamic. We're going to play it off of marketing. Let's say that there was effective marketing and demand is now picked up. As demand picks up, if supply stays the same, what's going to happen in this simple example is price will go up because demand is now exceeding supply. So as the car dealership owners, we're loving this scenario. We're selling the same rate of cars and our prices are going up and we're making more per each transaction. At a certain point, we're going to get greedy because that's what we do. And now we're going to increase supply because we're selling all these cars at increased premiums. And the greed in us tells us we could sell more of these cars, more total, and then hopefully get that same markup and make even more money. Eventually, at a certain point, as we introduce more supply into the market, that supply will start to overwhelm demand in this theoretical situation, which will cause reversion because now supply is greater than demand. So you will likely not be seeing people spending $30,000 on this truck anymore. It will likely shift back towards the mean at $25K and potentially go all the way to the other end of value where now supply is overwhelming demand and there's not that much of a pickup in demand. So you keep getting overwhelmed by supply and you go all the way to the opposite end of value where it's now considered cheap. Now that it's considered cheap as the dealership, as the market makers, we don't like selling our inventory at a $10,000 discount to what we were selling it at a week ago and a $5,000 discount to what is considered fair value for this vehicle. So we're going to decrease supply, and because of two factors, now A, supply is decreased, and B, this asset is considered cheap relative to fair value, demand will likely increase, which will cause that exact play that happened on the other end. We're likely going to revert back to 25K now because supply has decreased and demand has increased. And that is going to cause the price of this asset to go up. This simple example that we're depicting here around supply and demand and how we alternate around value is exactly the same concept that's happening with financial markets, how they range and how they trend. It's this cyclical nature of going back and forth between the two, establishing value, rejecting, establishing new value, potentially coming back to previous, or establishing another new value later on. This cyclical nature is what's explaining why price will predominantly be range bound, and then occasionally you'll get that momentum in the market where you trend.